Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. Last week's virtual Jackson Hole meeting of US central bankers was one of the most anticipated in years due to both the effects of the global pandemic and the unprecedented levels of both fiscal and monetary support needed to maintain the US economy. So what was said and what does it mean for markets? Well, who better to ask than friend of the channel, once again, Hugh Gimber, Global Market Strategist at JP Morgan in London. But first, before we get into the content, if you haven't subscribed already, it would be marvellous if you could. It really does help us to continue to deliver the best investment and financial planning content that we possibly can. So, cracking straight onto the content. Hugh, many thanks for your time once again. For those viewers who are unaware of the significance of this annual meeting, can you explain what the Jackson Hole meeting actually was?
Yeah, of course. Well, first of all, thanks again for having me back. Jackson Hole's a bit of a funny one on the central bank calendar because it's not a formal part of any of the main central bank's communications. So it's not like your sort of every month or every few months you might expect to hear from the Bank of England or the ECB or the Fed. This is a bit different. It's a one-off. It's a gathering of central bankers, of policymakers, of finance ministers, really to kick the tires on the global economy. The reason it's significant is because historically, some really big speeches have been made at this specific conference. So you go back to the financial crisis, you had Bernanke making some big speeches then. Draghi made a massive one in 2014, really sort of calling for people to rethink how monetary and fiscal policy should work together. And then Powell last year used Jackson Hole to introduce his average inflation targeting framework. So even though it's not a formal part of a communication policy, it's often been a source of big speeches, big events for markets.
Yeah. So mentioned in the intro, this annual meeting was one of the most anticipated in years. What was announced?
Unfortunately, not very much is the short answer to that. It was a bit of a non-event. I think the reason it was so hotly anticipated, as you say, is because everyone's trying to work out at the moment when we're going to get an announcement on tapering, when the Fed are planning to slow their asset purchases. And so there was some consideration that this might have been the time for Powell to do that. Instead, really what we learned is that he was sticking to many of the messages that the Fed have told us previously, that they think the economy is making good progress on the recovery, and that yes, there are still risks from the Delta variant, but they're getting closer to the bar that they've set to wind down asset purchases. So I guess the main message for me from last week is that, okay, Powell didn't decide now is the time to announce tapering, but the tapering is coming, and that an announcement most likely towards the end of the year is set to come, with the Fed looking then to use most of 2022 to wind down their asset purchases.
So taking that into consideration, are there any immediate thoughts that investors should be looking towards in terms of their portfolios?
Yeah, so a couple there. I don't think much changed on the back of last week, but it did reinforce, firstly, that I think the level of bond yields today is inconsistent with the strength of the recovery and inconsistent with what's to come from policymakers. So I know we've spoken previously about why bond yields have been so depressed over the summer. I think last week was another reminder that some of the odd skews in supply and demand in the bond market should be normalizing as we move towards the end of the year, and therefore that bond yields are likely to move higher over the next 6 to 12 months. Right. So for bond investors, that means you want to be flexible in your approach, you want to be as global as possible in your approach, really embracing the largest opportunity set available. And it also has implications for the equity market as well. So we saw in the first quarter of this year, rising bond yields, stronger growth, typically leads to rotations in equity markets towards more value-oriented sectors, towards more cyclical sectors. That tends to help, in turn, regions of the world with bigger weights to cyclical sectors, so the Eurozone being a good example there. And if we do see higher bond yields over the next 6 months or so, that would suggest that there's more room for that rotation in the stock market to continue.
It sounds like it's a period of possible risk on, which again, if the central bank, if the Fed's going to be saying, well, we'll just continue for now, we'll keep an eye on data, but we'll continue with our liquidity focus at this moment in time, then yeah, we could be looking hopefully at a nice positive trajectory into the end of the year. But then after that, who knows? Hugh, once again, absolute pleasure to speak to you. You take it steady, you take care, and I'm sure we'll catch up soon.